Hey there, welcome. If you've got an exam on bank reconciliation coming up, you are in exactly the right place. In this explainer, we're going to break down everything you need to know to absolutely crush those multiple choice questions. So, let's just jump right into the core problem, right? You look at your company's records and you see one number. Then you get the statement from the bank and you see a totally different number. It's this classic mismatch mystery, and today you and I are going to learn how to solve it like a pro. So, here's our game plan for today. We'll start with the mystery itself, introduce the main tool, the BRS, figure out why balances differ, then learn how to actually build the statement. After that, we'll test your knowledge and wrap it all up with a final cheat sheet. Ready? Let's get started. Okay, first things first, you can't solve a mystery without knowing the lingo. These are the key terms that are pretty much guaranteed to pop up on your exam, so let's nail them down. Now pay close attention, because this is the concept that confuses so many people. You've got two different records, the cash book. That's your record, your company's version of the truth. When money comes in, you debit it. When money goes out, you credit it. Got it? Good. Now the passbook is just the bank statement. It's the bank's record of your account. And here is the absolute key. It's the exact opposite of yours. When the bank receives your money, they credit your account. When you withdraw money, they debit it. Always, always remember, your debit is the bank's credit. This is beyond crucial for your exam. And this right here is our main tool for the job, the Bank Reconciliation Statement, or BRS for short. Now, this isn't a formal accounting statement. Think of it more like a detective's notepad. It's a special worksheet you create just to figure out exactly why those two balances, the cash book and the passbook, don't match up. So why don't they match? What's the reason for this whole mess? Well, it almost always comes down to just a handful of things. For your exam, I want you to think of these as the 9 usual suspects that an accountant has to investigate to crack the case. And here they are, all listed out. I know, it looks like a lot, but don't get overwhelmed. We can actually group these suspects into just a few simple categories. It makes them way easier to remember. Let's break them down. The first, and honestly the most common, reason is just bad timing. It's a timing difference. Think about it. When you write a check, you subtract it from your cash book right away, don't you? But the money doesn't actually vanish from your bank account until that person takes the check to the bank and it gets processed. Same thing when you deposit a check. You record it instantly, but it takes the bank a couple of days to actually collect the money. It's just a simple delay. Next up, sometimes the bank knows about money coming in before you do. A customer might go and deposit cash directly into your account. Or maybe you get some dividends from an investment that goes straight to the bank. The bank credits your account the moment it happens, but you probably won't find out until you get your bank statement. And you guessed it, the same thing happens with money going out. The bank might take its monthly service fee, or maybe you've set up a standing order to pay your rent automatically. The bank debits your account right then and there. But again, you won't know what happened until you see that statement. And finally, we have the category of surprises and, well, plain old mistakes. A check you deposited might bounce. Get dishonored. That means the bank gives you the money, then has to take it back. Or someone, either at your company or at the bank, might have just typed in the wrong number. Hey, it happens to the best of us. Okay, so now we know why things get mismatched. Let's get to the practical part. How do you actually build a bank reconciliation statement? This is the skill you're going to have to use in those exam questions. Before you start, you have to know what kind of balance you're dealing with. A favorable balance is good news. It means you have money in the bank. In your cash book, that's a debit. But remember the rule? For the bank, it's a credit. An unfavorable balance is an overdraft. You owe the bank money. And again, notice the opposites. That's a credit in your cash book, but a debit in the bank's passbook. Get this straight, and you're halfway there. The process itself is just simple logic. You pick a starting point, either your cash book balance or the passbook balance. Then you adjust that starting number for all those timing differences and other little things until your final calculation perfectly matches the balance of the other book. Let's walk through an example. We'll start with our cash book balance of $32,500. First up, we add $12,500 for checks we issued. Why add? Because even though we subtracted it, that money hasn't actually left the bank yet, so the bank's balance is still higher. Makes sense, right? Next, we add $5,000 for dividends the bank received for us. Again, the bank knows about this money, but we don't yet, so we have to add it to our number to catch up. Okay, now we deduct $8,900 for checks we deposited. Why? Because the bank hasn't collected this money yet. And finally, we deduct $400 for bank charges. Do the math, and you get $40,700. A perfect match with the passbook. We solved it. Now for a trickier one, an overdraft. We start with an overdraft for $6,500 in our books. That's a minus. Now those checks we issued for $1,000 that haven't been cashed, that's a plus item. Wait, what? Yeah, because it actually reduces the overdraft that the bank sees. But the checks we deposited for $3,500 haven't cleared yet, so that makes the bank's overdraft number bigger. Same for the $600 in bank charges. So our starting overdraft of $6,500 after all these adjustments becomes a $9,600 overdraft in the bank's records. You've learned the terms, you know the reasons, and you've seen the method. Now for the most important part, applying it. Let's look at how these exact concepts will show up in your exam's multiple choice questions. Okay, first question for you. Your company writes a check. You record it so your cash book balance immediately goes down, but the person you gave it to hasn't taken it to the bank yet. So what does that mean for the two balances? Take a second to think. The correct answer is B. The passbook balance is higher than the cash book balance. Why? Simple. You subtracted the amount from your records instantly, but the money hasn't actually left the bank account yet. So the bank's record, the passbook, is still showing that higher amount. All right, let's try another one. This is a straight-up definition question, the kind they love to put on exams. When you have an overdraft, what kind of balance is that in the bank's records, the passbook? And the answer is B, a debit balance. Just remember our golden rule. Your record is the opposite of the bank's. An overdraft means you owe the bank money. From the bank's perspective, they're expecting to get that money from you, so they record it as a debit on your statement. All right, let's bring it all home with a final super quick summary. If you only have 1 minute before you walk into that exam, this is the slide you need to look at. This is your TLDR, your ultimate cheat sheet. Here it is, the whole thing in a nutshell. The purpose of a BRS? To explain the difference between the two books. The main causes, timing, bank actions, and simple errors. A favorable balance is your money. Debit for you, credit for the bank. An overdraft is the bank's money. Credit for you, debit for the bank. And the process? Start with one balance, add and subtract the differences, and arrive at the other. That's really it. So there you have it. You are now fully equipped to solve the mismatch mystery and totally ace that exam. Which leaves me with one final thought for you. Beyond the test, after learning all this, what's one mistake you'll be extra careful to avoid in your own records from now on? Think about it. Good luck.